Good evening, everybody. Welcome back. It's been quite an interesting month since we last spoke to each other. What I think with the Fed coming up tonight, it's worth focusing on that. It could set the tone for the rest of the year, and possibly even into the next year as well. Markets are beginning to price in some pretty big rate cuts as we go forward. And since early November, the markets have been pricing about 100 basis points plus in the US, for instance. If we look at the Fed, the ECB, and the Bank of England, they represent about 60% of the global economy. So obviously, these meetings that we have this week are massively important. So if we look at the breakdowns with these, the Fed is we're looking at pricing of 1.1% rate of interest rate cuts in 2024, first cut as early as May. The question is that going to be the case? The ECB expected a 1.3% cuts in 2024, first cut in March, so possibly the first central bank out of the majors to cut. Is that the case? More questions there. The Bank of England expecting to cut rates about 1% in 2024, with the first cut in August, so the last one to cut. So some questions arise from this. These central banks are not going to move in lockstep. So what we need to ask ourselves is if the pricing is correct, first of all, and whether the fact that there's going to be a different timing for these cuts, if and when they come, if there's opportunity out there. So, if we look at some of the charts, we've got the S&P or the USA 500 daily chart since October on the right, and we can see the pretty broad rally that we've had since October the 1st. This is impressive. And, the idea that these central banks are going to be cutting quite aggressively has helped push these equity markets quite a bit higher, as you can see here on the chart on the right. You look at the German 40 daily chart, and we're at an all-time high here, which is quite impressive considering how weak not only is the German economy, but the EU economy, and the fact that inflation is falling away very quickly. Now, at some point, we may get to an inflection point where stocks are less focused on the fact that central banks are just stopping hiking and looking to cut, to focus on why they're cutting. And is that if we're going to see 1% of cuts next year, is that because growth is stalling very, very quickly? Is that a concern for earnings in stocks and the rest of it? So what we have seen, though, is these rate cut expectations really push equities quite a lot higher. So we've got a couple of questions that come out of this. And question one, are the current rate cuts priced by the market for the Fed, ECB, and BOE in 2024 for a step too far? Well, one of those questions is going to be answered tonight because we've got the Fed in about 25 minutes, but also we've got the Fed's Powell's press conference as well, half an hour later, which we may get more information from. But there's some points to consider here. And first of all, the divergence between central banks and markets. This is key factor because core inflation in the US is nowhere near where the Fed wants to see it. So they haven't met their targets yet. So could there be some pushback against the market pricing at the moment? Now, what does that mean? Well, to do that, Powell would have to sound quite hawkish and say, look, you may be pricing cuts. We're not thinking of cuts at all. We still are leaving the door open for further hikes because of the data they've seen recently. And there's some argument for that. So that would have to be quite a hawkish stance for the market to take on board. And would they believe them? So whilst inflation may be under control in many economies, the central banks are still very much data dependent. And this is really quite an important thing because inflation is not back to target yet. But I'm just wondering if there's any upside for central bankers to actually suggest, central banks to suggest that their job is done fighting inflation, because what they don't want to happen is to stocks to race higher, the wealth effect increase, showing support for consumer confidence and spending, and adding to the inflation problem. So I'm struggling to see why the Fed would really want to be very dovish tonight. But it has to be said, some of the economic data, whilst resilient, is actually beginning to turn down. But this resilience in the US economy does suggest that it's a bit early to be suggesting they could be cutting as early as March or April or May, which we've had priced in the past. And that's gradually being moved back as we come into this meeting. Excuse me. So it will be very interesting to see what Powell has to say tonight. But we have to say that in the EU, for instance, economic data is extraordinarily weak. There is no two ways about it. We've got rapidly falling inflation as well. So it seems to me that the job may be done. Now, the problem with that is not only is the job possibly done with fighting inflation, but due to the lagged impact of interest rate hikes, the pressure is still coming down the pipe from recent hikes. And I think the danger here is that pressure remains on the economy. So having said that, the market is pricing that. And so therefore, President Lagarde would have to be pretty dovish to meet expectations in the marketplace. On the UK side of things, the UK economic data has actually got a little better. It's beaten rather low expectations. And inflation is far from under control because wages are still rising, unemployment is still low. So the BOE, for instance, may be forced to stay higher for longer with this this narrative that they had in the past until something gives in the data. And I think that's very problematic, but it also shows that there's some divergence and some opportunity maybe in some of the sterling crosses against either the dollar or the euro and things like that. So I think what is clear here is that risk for stock indices and FX markets are skewed towards disappointment. So I think we could see some volatility over the next couple of days. And I think that's going to be in equities. I think it's going to be in foreign exchange markets as well. So, if we look at the recent dollar moves, the dollar peaked at the start of November and fell about 3.5% across the month. As you can see here with the dollar index, it's been quite a big sell-off. However, in December, we've seen quite a convincing turn in the dollar. We've started to see US yields start to move a little higher. In the US, as you can see here on the chart on the right, US jobs data points to a strong labor market still. And with a strong labor market and consumer confidence rebounding strongly, as seen in the chart here on the bottom right, from the Michigan data that we had last Friday, it seems to me that it's going to be quite difficult for the Fed to actually turn out and say, look, we're done hiking rates. The markets, we're ahead of the curve with inflation and the economy is weak. It just doesn't seem to show in the data we're seeing at the moment. So the danger here, whilst equities are priced for perfection, that there could be a bit of a wobble out there if we get something more hawkish from the Fed. So we need to ask ourselves in the FX markets, is the dollar now in a downtrend? Well, we're expecting interest rates to come off. We've got 100 basis points of cuts in the market. So we need to look at the points to consider here. Interest rate differentials and market expectations move FX markets. So what we're seeing is there are some concerns over the continued US economic exceptionalism. Without doubt, the US economy is stronger than the EU and probably the UK and certainly Japan and possibly Switzerland and many other European nations as well. So this has a natural effect of actually turning the dollar back up. So this US economic exceptionalism against what's going on in, for instance, weaker European economies and possibly even UK as well, drives the dollar back up. And the euro, as you can see, since that October the 1st level, having traded up as high as 110, has really performed quite badly since then, falling into this week with the Eurozone really facing a recession, disinflation and potentially deflation. And I think what's happened here is, again, the EU is in a bit of a spot here because there's more pain coming on an already weak economy from recent rate hikes that lag. They take a long time to come in to impact the economy. That is still to come. So the EU looks structurally softer or weaker than the US, which may be what's driving the euro down at the moment. And that chart shows that really nicely. Sterling Slightly different, but the same overall. We have a situation where the dollar exceptionalism or the US exceptionalism is still pressing slightly on non-dollar products like sterling. But the fall has not been quite so bad because the economy is better in the UK, some more structural positives, if you like. But the UK is potentially facing some form of stagflation here, where inflation stays rather high with wages still rising, but a slowing economy. Not easy to deal with for a central bank, but certainly the real weakness seems to me to be in the Eurozone. Excuse me. So, what we have seen is tech stocks have outperformed just about everything, and US stocks have outperformed most others, particularly the UK. Technology stocks, the Magnificent Seven, if you like, have been the foundation of index gains for the whole of this year. And if you look at this chart on the left here, you can see this 49% rally in tech stocks. This is really impressive for this year for all that's going on. But just take the FANGs stocks. I mean, this is the stocks you have on your screens in the FANGs index. You know, an 85% increase. This is just incredible. And, you know, it's very difficult to stand in front of the Nvidias, the Microsofts, the Alphabets. These are very strong companies with a lot of cash, and they've done extraordinarily well. But, you know, can this continue any further? Is everything priced for perfection? And I think what we need to be considering here is, will markets bank some profits on technology stocks into the end of the year? They've had a very good run. The VIX, which is the fear index, as you know, on the S&P, is extraordinarily low. And so actually hedging downside for professional traders is actually very cheap. But central banks may not be ready to confirm an end to interest rate hikes. Now, that could weigh quite heavily, particularly on tech stocks. If we start to hear a more hawkish commentary from the Fed tonight, just be wary of what that could do to stocks. They may push back on recent easing of financial conditions, which makes their mandate to beat inflation much harder, because as financial conditions ease, you see stocks rise, you see bond yields fall. You get this wealth effect that gives confidence to traders and investors. They then spend more money, their confidence is high, and it adds to inflation. Now, recently, it was quite interesting that we saw the Meta head, Mark Zuckerberg, actually selling company stocks. This is quite interesting. First time in a couple of years. It seems to make a lot of sense when you've made 150% profit on your deals. So, you know, I get that. And some analysts have stated now is the time for AI to prove it can produce profits for companies. The issue here is that AI companies have been priced to produce what they're expected to price. What we need to see now is the proof of that. So buying the likes of Nvidia and some of these other AI companies, I think a lot of that work has been done. So we just need to consider that into the end of the year. And these are all valid points. But however, the trend is still very strong. And many traders are reluctant to give up on these long-term gains that they've seen. And they would rather hold on to them until they have to sell. So if central banks do signal a willingness to consider rate cuts in 2024, I think we'll see stocks continue to move higher. If we get a soft landing in the US economy and the inflation drifts lower without crashing growth, then I think, again, stocks will do very well going forwards. And I think that is the key. Obviously, the flip side applies as well. So interesting times. I think, you know, there is no guarantee that the Fed is going to meet market expectations today. The ECB, I think, has a far harder task because I think the economy is far weaker, whereas the Bank of England has a slightly different idea. There's a bit of stagflation going on there again. So it's going to be difficult. I would let the dust settle on some of these meetings before taking a strong view. But there is opportunity out there along with some of the risks as well. But I think it's a very interesting scenario at the moment. We're in a very, very important week that could set the tone well into next year. So that's me for this month. I hope to be, and basically before Christmas and the New Year. So I would like to wish you all a very, very good Christmas. I hope you've had a good trading year. I hope you have a better one next year, and I will see you in the new year. Thank you very much.